We'll start in a minute here. Yeah, we're keeping an eye on you. It's a troublemaker. We could probably go ahead and start, right? A little early. Seems like everyone's in here. I'm Mark Myers. I'm with KISER Group. I've been brokering, selling facilities, representing sellers for over 30 years, and OG, old guy in the industry. Trained a lot of the brokers that are in the space and love doing what I do, and started a new platform with a friend of mine, Lee Kaiser, who sells multifamily in the Midwest. And it's been a really good experience. We have a lot going on activity-wise, so I think everyone does in the market today. So that's who I am. I live right here in Oak Brook, about 4 miles to the east. So really love having the conference right here in our backyard. And then we'll go to Jason next, and then just keep passing it down.
Nice to meet everyone. Jason Dopoulos. I'm a managing principal and founder of Ikaria Capital Group. We're a bridge lender and HUD lender, an ABL lender to the nursing home space. I've been doing it for almost 20 years, and I'm based out of Cleveland, Ohio, and our firm is national. We lend all across the country.
Brian Robinson, Old National Bank, which is headquartered in Evansville, but based here in Chicago. Home game for me, just like Mark, live about 4 miles away, so it was actually weird waking up and not have to be at a hotel and whatnot. So the bank's about $75 billion in assets, healthcare portfolio, $3.5 billion spread across mostly senior housing and a little bit of hospital side. I focus specifically on the skilled nursing side.
Hi, Karina Davydov. I'm with MONTICELLOAM. We are a seniors housing and multifamily lending platform specializing in bridge financing and asset management. Right around $7.5 billion of loans under management currently. I lead Originations for the healthcare side, where we focus on skilled and seniors. I'm based here in Chicago, have been with Monticello about 4 years. Monticello is headquartered in New York, but we lend nationally.
Matthew Tyler with CIBC, a commercial lender based here in Chicago. Big healthcare platform. I've been doing this for about 16 years, and Chicago's home to me also.
Okay, and we thank you all for coming this morning. I'm sure you're from all around the country. Glad you got in with the weather and everything. I'm just going to run through some stats quickly because people are asking, what's the industry like? I presume most people are here for skilled nursing. About half of what I sell is seniors housing. The other half is skilled nursing. The SNF sector, skilled nursing facility sector, occupancy rates rose to 79% in July of 25 as compared to 77% a year earlier. Publicly traded SNF owners and operators reported some pretty huge gains. I think Ensign, their revenue was up 7.4% last year. PACS was up 31%, and NHC was up 8.7%. CMS issued their final ruling for the increase in Medicare rates for 26. It was 3.2% net increase to SNF under the PPS system. And people were expecting something there or even a little less. The year before was 4.2%. So even though, I'm sure people would have wanted more, but they were happy with the 3.2%. At least the rates went up. The one big, beautiful bill signed in during 25 plans to cut Medicare costs by about $500 billion over the next 10 years. And Medicaid, they have cuts in there for about $900 billion for the next 10 years. So obviously some headwinds there, potentially or likely. But SNF owners always find a way to work within the given system to provide care for residents and make a profit so that they can continue to grow because profit drives mission. The Community for Responsible Budgeting estimated that Social Security and Medicare trust funds will be running out of money by 2032. It's probably no surprise to anyone, but Medicare and Social Security are in trouble if they don't either raise taxes to refund them or print more money, or there are probably not too many good options raising their retirement age, doing something to mitigate that loss of funds. The largest healthcare REITs are reported increasing volumes. Collectively, Welltower, Ventas, CareTrust, Omega reported gross investment activity last year of $25.3 billion. That was up significantly from $10 billion the year before. And so that was a good sign for the industry too. a lot of them have fairly inexpensive capital. HUD reported fiscal loan volume of almost $6 billion through their 232 program last year, and that was double what it was the year before. Fannie Mae is getting their portfolio under control very well. They're down to about a $12 billion portfolio from $15 billion the year before across 513 loans. And they have a default rate that is delinquency rate that's down to less than 2%. It was a little over 4% the year prior. So Fannie Mae is back strong and making loans, and so is Freddie Mac. Those are more for seniors housing, not skilled nursing. They don't do skilled nursing loans. Capital markets environment became more stable in 25. The inverted yield curve, which emerged in 2022 and lasted through 24, has returned to a more normal yield curve in 25. So even though rates are a little bit higher than they were, in pre-22, there's a lot of stability, and we'll talk about that, I'm sure, a lot this morning. And spreads on commercial real estate have tightened a little bit. So that's good for the industry. That's why one of the factors that's been improving transactions. So these conditions, along with a lot of new entrants to the market, have really, caused a good influx of transactions. And not only that, but there are different avenues of financing that have opened up. A couple years ago, in 2022, Jack Dwyer's group formed a nonprofit to buy about 50 or 60 facilities in Texas through a nonprofit that is now used to develop personnel within their organization, within the nonprofit, training them, giving them sponsorships for schooling, and so forth. So these are some of the types of things. I've also seen it in seniors housing. I have a client in Wisconsin that did a $250 million bond deal, and one that I'm working on now that's a tax-exempt bond deal in New Jersey. So bond financing, as well as HUD, as well as commercial and other forms of financing have become a lot more prolific in the last few years. So with that, I'm going to kind of turn it to the panel, and we definitely want to leave room for questions. So the first question is, what types of acquisitions have been the easiest or toughest to finance, and why? And we're going to start with Matt, and then we'll go to Jason and ask him on the HUD side what's been the easiest and toughest. So.
Sure, Mark. Thanks. Thanks for having me. I guess I would lead that question by saying a whole lot's getting done right now. We can talk about, where you may not hear a no, but you may hit some headwinds. I think if you've got something that's clinically challenged, as a special focus candidate or designee, you're probably going to run into a little bit more work. The candidacy, obviously, HUD is not financing, but there are lenders in certain situations. CIBC will lend if the story makes sense or if it's a sponsor we're comfortable with. If you're a designee, hopefully you're part of a portfolio of other homes where a lender could maybe look and say, okay, worst case, if this home falls out, am I still in okay shape? I think you may run into some headwinds on deal size. If you're sub $10 million, you're probably going to be looking a little bit harder for a lender right now. And then unfortunately, I think for new entrants right now, especially if you're trying to take something on that hasn't worked since COVID, you're probably running into some problems financing if you don't have a big name attached to you. What is working in the market right now? Top tier sponsors, good sponsorship, cash flowing deals, portfolio deals of good size are getting gobbled up right now.
And I think what has worked well too in the last 10 or so years, maybe longer, is the money sources like the well towers and some hedge funds. It could be a trading company, importer, someone that has a lot of cash coming in the door, may have access to low cost of capital, is financing a large owner operator like an Apex, a Cascade, someone of that nature. And then those folks are bringing in the younger operators, the more, because it takes a lot of energy to run nursing homes, as we know. It's a lot of work. So they may parcel out 40 facilities to 4 or 5 different operators, and then as those young operators gain traction and prove themselves, then they may have, in some circumstances, in some cases, a purchase option. And at that point, maybe they can, find a loan. But once they prove themselves, so I think that's helped fuel a lot of the business too, where the young folks can come into the industry on the tails, if you will, of the bigger operators. So anyway.
Yeah, I would add to what Matt said. So, let's say CIBC does a bridge loan. HUD is more programmatic in how they'll lend mathematically, right? So they'll underwrite your trailing 12-month performance. There's certain debt service coverage that you need. That's 145. There's certain eligibility requirements that the sponsor needs. Also, if they're brand new, it's harder for them to get a HUD loan if they haven't operated the facility for a year. There's certain rules. So on the bridge side, where the group up here can be a little more creative if it's a sponsor they know, if there's a turnaround story or anything like that. When you go to HUD, you got to kind of fit into this box, right? You can't really deviate much. You can't make many adjustments to your expense structure. So really, the bridge process that all these bankers up here will lend to is just getting everyone ready for that point where I can look at the deal, and I'll work with all these groups up here to say, this is what we need to go to HUD, and we kind of understand the box, because the feds don't really adjust on their underwriting. If you're, everyone, whether it's Ensign or PACs that are publicly traded or a local operator, it's the same rules, because all the deals are non-recourse and they're single assets. So even if there's a portfolio that Matt underwrote and we're working with them, I have to make sure every loan underwrites it on its own to fit. So it's there's a lot of work that goes on when you close your bridge loan to make sure that we can take out our friends up here in the panel.
So when does a lease to purchase structure make sense, Matt?
I mean, for a lender, we love it. You've got a demonstrated history. I think for a new entrant or maybe an experienced operator that's capital constrained or doesn't want to bring in equity, I think it's a great solution. And for a landlord, it can make sense too if the deal terms are right. If you come in and you exercise your purchase option, you've got a history, you can finance that at 100%, or in this market, over 100%. If you've got EBITDA of $2 million a year, that would generally equate with a debt amount around $12 million. If your purchase option price is at $8 million, you could be cashing out on your purchase. I will say that, I said earlier, I think for new entrants it's a little harder. I think it's been a little bit harder also. I think the sellers are also adept to some of the new entrant issues, and partnering with a big name can help you if you're out on your own. I think you've got a little bit of headwind. I think also another headwind for new entrants under a lease purchase model is, I think we all remember, tenants going into these where your purchase option was in 2 years, so you could kind of come in, prove yourself, and get financed. I think that's generally floated out to about 5 years now. But it's a great product.
Yeah. It takes a while to turn around a facility many times, and someone once famously said, not all turnarounds turn around. So hopefully they can get them. Jason and I were involved in a big deal here in Illinois about a little over a year ago, that some older facilities, and some of those will do well, and some will be a little tougher. Some may even need to be closed. So with these new entrants coming into the market, Brian, Karina, and Matt, what do you see as far as new capital influencing competition, deal terms, and where is capital being deployed? Who wants to take that first?
I can take that. We've certainly seen a meaningful increase in deal activity, but I think lenders are still cautious, focusing on the operator first. It certainly helps the transaction where there is an experienced backer that has a track record of showing those kind of turnaround opportunities, and where the turnaround has turned around. So I think, there is certainly a lot of competition out there from the lender ranks for every deal that comes about, but they're certainly focused, and us included in that, on sponsor first.
Yeah, I think what you were talking about before with the lease to purchase, that's fantastic, because it's a runway to see if the people know what's going on. Taking a step back, one of the things I was trying to equate to my senior in high school, he's like, I don't understand why it's so hard to get these things done. Not what I was talking about when I was 17, but that's there now. But I said, it's gotten so competitive, but it's also gotten so much more technical, right? So there's just so much more going on that you can't really, it's really hard to lend to that single shingle kind of guy anymore. You have to have that back office. You have to deal with, in the state of Illinois, Medicaid, Medicare, where you're fighting with insurance to get your reimbursements. It's gotten so big that you have to have a portfolio home. So in the case of Old National, we're not looking at onesie, twosie kind of situations. It almost has to be a portfolio, right? And so taking another step back to what we're saying, what's getting done? What's getting done is the bigger ticket items, right? It's the $7, $8, packs. You have to go in with other banks and figure out a way to get it done, or the Monticellos, because the smaller types of transactions, there's inherently more risk with just less of diversification. We love seeing the facilities across a variety of states, not necessarily just all within one state, but then that opens up the other side of it, where I'm talking about both sides, where you want to have boots on the ground. And so sometimes when I'll see someone come into Illinois and they say, well, we're combining stuff in Illinois, Iowa, Minnesota, you really do need regionals in each one of those places and have a good working relationship with the state. So in one way, we want the larger portfolios, but it has to be to a group and sponsor that has a wherewithal and has boots on the ground to be able to make it work. So across the board, but it's more capital coming in. It's not just that simple, right? You can have a ton of dough, but you gotta be able to execute on it.
Mark, one thing I think is important to talk about is why. Why is this happening? Why is all this competition occurring? And I think it's a confluence of factors, really. First of all, banks are very happy with their books right now. You've probably got problem loans at the lowest levels that they've been in a long time. You've got deals that are running off to HUD. And if you think about this, if you're a lender and you've got, every deal you book is probably going to be gone in about 2 to 3 years if it's working properly. It's a vicious treadmill. So if you had a great year and you booked $350 million, but $300 million went off to HUD, you didn't do such a great job. REITs, I think, have become net buyers, where we saw them in the past as net sellers. I think the market fundamentals right now are amazing. We've got Medicaid rebasing, staffing's floating down. There's relief on debt service. So you've got this whole confluence, and then you add in the alternative lenders or the private credit or the finance companies, which really filled a gap, during some of the dark points in the market. The old adage, a bank will only lend you money when you don't need it, came true. And I'm proud that CIBC lent all through COVID, but there was a big hole in the market that was filled. And these finance companies are doing a tremendous job. They're writing big checks. They're closing quickly with certainty. Their spreads are good. Their terms are good. And so you add that into the confluence of what's going on. And then acquisitions. Acquisitions are light right now. And we can talk about the reasons for that, but that piece of the market's missing. So this is all kind of generating into a situation where refinances and the acquisitions that are out there, there is a lot of activity. There are a lot more people that want to lend money than need to borrow money right now. I think there's a lot more people that want to buy properties than want to sell right now.
What would you say are the factors? Go ahead, Jason.
Well, I was just going to add, we're not owned by a bank, so we're kind of like on the private credit side, and so we're out there talking to big investors about our sector. And in my career, I've been net positive on SNFs for a long time, and investors were just like, no way. Like the insurance companies or, big P funds were like, we don't like that risk. But now, right, we've came out of COVID, other asset classes, the yields are being compressed so much. If you think about industrial, multi, other asset classes that people see as, kind of conservative, I think our sector's proven to be a little counter-cyclical, right? Like the yields you get, especially on lending, can be kind of stable. So the fact that, we're getting reached out to by very, very large funds tells me there's just a tremendous amount of capital coming in, right? And so you're going to see, as a borrower, it's good for you, right? Spreads tighten, there's more competition. But then to your point, like the M&A set a record last year, right, on transactions. But I think a lot of people now are waiting for like true cap rate stable deals. Like there's no more deals out there for buyers. So then when we're lenders, we're making sure we're lending on an appropriate value that will get to HUD. Like when I talk to the banks up here, we're always like, well, what level can get me out, right? Do you want to set a record in the state? Probably not, but that's happening a lot because the cash flows are there. So we all have to kind of put our heads together to make sure we can keep that cycle running because, the banks do get paid off, but they also don't like when a loan's out there for 5 years getting extended, right? So it's like a happy medium, but there's so much capital out there. And even more on the private pay side, we're not really digging into that, but, there's all these large funds are now putting their eye on our sector.
I think going back to the returns and the capital, it took a long time, and this is what my hypothesis for it took a long, long time for the sponsor side, and this is more on the senior housing side than SNF, I realize, but it applies to both, where it was frothy. Like their returns for years and years was so high, right? And then things came down, and there was this little bit of the clog in the sales, and everything else was going on because people wanted more and more and more. And I think now there's a recognition that maybe you're not clipping 20%, maybe it's 15%, I don't know. And now that I think there was a realization, it's like looking in the mirror. It's okay, well, we're still making 15% on a pretty safe investment all in all. And so I think there's just more of that coming in, realizing they're not getting 25, but they're getting 15 to 17, and they can do okay on
Which
that.
they're happier with as long as it's a stable,
For sure.
a more
And
stable,
that
yeah.
flight to
Yeah.
quality. I mean, I
Yeah.
think there's a big bifurcation in what gets done, right? I mean, turnaround stuff gets done, and you know, value add certainly, but you can see it on the spreads more so. I think this is more anecdotal than micro level, but there's a wide disparity now. I mean, the fairway transaction, everyone's dropping spreads like no tomorrow. So, but I think there's also, because the sponsor side said I can still clip 12, 14%, and that's pretty good because I know it's not going away for 5 years.
And to you guys' point, I think COVID, as strange as it sounds, was good for the industry in the sense that, you know, obviously no one wanted to see people get COVID or pass from it, but it really woke up the nation and the feds and states regarding, you know, the need for funding, staffing, and so forth. And a lot of those combat pay sort of staffing reimbursements that were in place during COVID were left in place, or reimbursement was increased in many states to accommodate the increase in staffing. Because as we know, once you raise the minimum wage from, let's say, $7.50 or $8 or $9 to $15 or more, in some states might even be higher, you know, you can't go backwards. You know, you're only going to go forward with wage rates. And so, you know, the feds and the states realize that they have to compensate for that. And so I was just talking to somebody in the last room, you know, who would think that in Kentucky you're having rates of $350, $360, $380 a day, you know? But it is a pretty common occurrence that in some of the smaller states population-wise, you have positive, you know, you have, instead of budget deficits, you have surpluses, or for whatever reason you have, you know, more federal dollars coming in per capita. And so some of the smaller states in Arkansas, Indiana, Kentucky, Tennessee can actually, and some of the very southern states, Louisiana and so forth, Alabama, they can actually have really good reimbursement rates. Montana's another one. So it's not always the California and New Yorks that can attract investors, particularly from the fact that, you know, some of the states that have some more difficult politics, like Illinois and New York, and some of the regulatory issues, it can take, done transactions in New York that took 3 years. So, you know, and just to get the change of operator approval. So these are some of the factors that weigh in on transactions. So once you open up that whole middle of the United States for transactions for nursing homes, more so than even senior housing, although people are moving for the warm weather and so forth to the south as well. The Nashvilles and so forth are exploding. Dallas, you know, with population. So senior housing is also doing well in those areas. Jason, update us on the HUD process. What's going on there? You just met with the commissioner.
Sure.
Tell us.
So obviously, you know, HUD's been a stalwart for the permanent financing for nursing homes for a long time. You know, private pay assets, you have more venues to go. Fannie, Freddie, life insurance companies, CMBS can take out the banks up here, but, you know, HUD has really been the permanent takeout for nursing homes. So, you know, it's known to take a long time. It's bureaucratic, but it's non-recourse 35-year money, so everyone kind of puts up with it. But the new commissioner, he came from the banking side, right? He worked, Mark, he was a banker at Walker & Dunlop. So it's the first time in my career we've had a commissioner who's been in our little corner of the world. Because if you think of HUD, it's single-family mortgage is gigantic part of it. Multifamily, and then senior living is like this minor, even though the numbers are big, you know, them doing $6 billion, they're going to probably do 7 or 8 this year. It's a big number to us, but to FHA, it's not that big. So they really haven't paid much attention to it. Now, he came in and has been fixing a bunch of things. The number one thing has been he's kind of put in what's been called an express lane for lower leverage deals to go faster. So HUD will lend to 80% loan to value. If you go in at 70, you go into a different line, and we've been getting commitments in 1 to 2 weeks as opposed to 6 months. Now, what he has to fix next is the closing queue, which that's when it goes into HUD's legal team, because HUD's legal team works for a different part of the government. And he can't tell them what to do, basically, right? So they're trying to fix that so people can get through. The goal is to make it similar to Fannie, Freddie, or a commercial bridge loan, where we can get done in 120 days versus 6-7 months. Now, fingers crossed we get there, because HUD did lose some staff during the Doge period of time, but the staff that stayed was really the productive people because you've seen their volume go up. Some other initiatives are we're trying to get more of independent living in, which again, this is to get it as an alternative to Fannie Freddie. There's been talk of, maybe reducing the mortgage insurance premium, which should be great. He did that for the multifamily industry, which just makes it more competitive rate-wise. Because right now, there's no risk-based pricing, right? If you go in at 80% leverage, the feds charge you 65 basis points. If you go in at 50% leverage, the Fed charges you 65 basis points. So talk of maybe fixing that. But it's just been very much commercial. Like, I didn't meet with a FHA commissioner ever outside of like saying hi after a panel, and he's been opening up to the associations. I was there with Argentum, which is a private pay association, trying to work on some other changes. I think one of the last ones that I just slipped my mind is in the senior living world, there's a rule where you have to wait to go to HUD from 3 years of a new asset being opened, which it doesn't exist in the multifamily space. So he's trying to change that as well. So if someone's developing a nice asset, they might get a bridge loan and they can go to HUD quicker and instead of waiting around. So just, you can work around the edges with HUD. Some things take changes to statute, which takes Congress, which we know that's never going to happen. No one's going to go in front of Congress to try to change rules to make it easier for for-profit owners to, get loans quicker. So he realizes where he can make changes, and it's been helpful. But their underwriting, it's still kind of the same, right? No SFF list. 1-stars are tougher to get through. Portfolios trying to improve how quickly they can go through. So not major changes, but the program's going to set another record, right? Which is great for everyone because there's predictability. The worst thing for the banks and groups like Monticello is if we do a loan and no one knows where it's going to go, right? So even through COVID, they were doing deals, and I guess the biggest takeaway is forever. The HUD program it's basically a negative credit subsidy for the feds. It makes the feds money. The default rate's like basis points, and they're getting 65 basis points a year on this portfolio. So Democrat, Republican, no one's going to cut it, right? It's not going to go anywhere because there's really no programs that make the feds money.
That's a great point. And I like your point about how if we can get business people involved in some of this decision making along with the federal and state governments, we can institute good programs. In fact, in Illinois, we have one of the better Medicaid waiver assisted living programs. It's called the SLP, Supportive Living Program. The facilities are called SLFs, Supportive Living Facilities. They have very high margins, very high occupancy, which is what's driving the margins. So they only require, part of the business aspect was they only require, I think it's 28% of the facility to be Medicaid waiver. The rest can be private pay. So you have a good mixture in the building of people that are on Medicaid, people that are paying privately. The private pay rates are obviously much larger than the Medicaid rates, but it allows owners to fill up the building to 95 to 100% occupancy in some cases. A lot of your costs are fixed or semi-fixed, and so your margins can be as high as 40 to 45%. Sometimes we've seen, and there were a lot of business people. Wayne Smallwood, Brian Clough, a lot of people in the industry were involved in helping develop that program in Illinois. So if we can do the same thing on the SNF side and get some business-minded people involved in some of these financing opportunities like Frank Cassidy's done and some others, that'd be really helpful. Well, what do you see as a panel? We'll just open it up to anybody who wants to comment on any further information on tailwinds you see coming or headwinds you see coming in the next 1 to 3 years for the industry, particularly the SNF industry, financing industry.
Where we're having our biggest problems right now is just we're OCC regulated, and there's more and more oversight. I mean, it just continues to be. I was on a call with Credit this morning, and it's a transaction to a good sponsor. The turn makes a lot of sense. There's mitigating circumstances, but the way things are working in our shop and other shops, I know for a fact, 'cause I talked to my contemporaries elsewhere, we're not allowed to give credit for reserves, for example, or through the cap stack in other situations. And so it ebbs and flows, right? A year ago it wasn't this much, and then recently they've been a little more draconian on how they want to risk rate. And at the end of the day, as a bank, which helps out the Monticellos of the world and whatnot, there's always other options for those in the room. But I can't beat City Hall when it comes to risk ratings, right? If they're going to tell me it's in our world like a 6 risk rating, there's no way I can get it done. So that's the thing that can be A, frustrating, and B, can be hard, is just working through what's the latest and greatest, what's the concern. You know, like last year it was more so star ratings, right? Star ratings became this, you know, much bigger story than in the past. In the state of Illinois, we all know star ratings are hard to do with the reimbursement, with the way it's hard to have, the way the nursing homes here are to have anything more than a 1 in some situations, yet they should go back going off to HUD. That's a whole different situation. So last year was star ratings. This year it's more about cash flow. So we continue to be more cash flow focused in our world because that's what we're being judged on.
And then going back to the star rating thing, as I understand it, you know, I think what you're saying is in some markets you may not be able to get the staffing that you need to have the star rating, you know, higher. Is that the issue?
It doesn't work.
primarily?
Yeah, I mean, just the numbers don't work. To be, this is really the nursing side of things. To have that where sometimes we're being told, the operators are being told they need to be, like, it would just kill the bottom line, right? And so, and maybe the demographic in the facility isn't that high of acuity, so it doesn't make any sense. But there's just rules on what goes on there, and that's the world we live in.
Getting away from a one-size-fits-all would be really helpful.
Yeah,
on the
but
star
that's
rating.
not going to change.
They've been talking about changing the star rating system for so many years, and you know, hopefully they'll get around to that. You know,
Yeah, but now, like, even though that's iterating, it's changed to a positive. In the past, it was the overall rating. Now it's really about some of the care quotients, right? Some of the subcategories where we're being asked to explain and see. And so if that's good, then we can understand some of the other star elements to it. So it goes back and forth.
Any other headwinds?
And I think that goes back to what Jason said and what Matt said as to, you know, ultimately all of us up here are looking at what's going to be the exit. We need to make sure these assets are eligible to go to HUD at some point. So you have to work closely with HUD lenders in order to see what are those rules. And as those changes happen at the government level, that so in turn shifts our underwriting. You know, we've done things like hire third-party clinical consultants. If we're looking at a turnaround that we see a lot of potential in, you know, again, who is the sponsor? Have they done this in other states? Do they have the wherewithal to weather these changes? Are they going to be able to afford the burn? Are we there to support the burn? You know, there's so many things that go into that, but you have to, you know, get creative. I think we have some of that flexibility as a non-bank lender, as Brian mentioned, to weather some of those changes. And so that's where you have your non-bank lenders in the market that really play a role, because we can, you know, they can come in and they can take a little bit more risk. Obviously, it's a slightly higher cost of capital, but there's certainly room for that there, particularly with, you know, the operator consolidations, the distressed assets that are coming to market, the value-add acquisitions, et cetera.
I would say, too, there are lenders out there, CIBC being one, that while our expectation is that our clients will go to HUD, we'll hold the loan. One of the first nursing home loans I made just paid off, and we had it for, I don't know, almost more than 15 years. It was almost emotional for me. I was like, are you sure you want to pay this off? But, you know, so that is also an option. But also, you asked about headwinds and tailwinds. You know, we talked about the competition, but I don't know that we really dove into what is the result of all that competition. Brian mentioned there's definitely spread compression. I think we've seen compression on the recourse side. And then, you know, for anybody who's taking a large portfolio out, I think we're seeing a lot more competition in the syndication markets. And not to get too wonky, but when you're taking, you know, bring a big package to a lender, they're going to take it to the market in one of two ways: the best efforts, or they're going to fully underwrite it. Best efforts is we're going to do our best to kind of find a home for this deal, and we'll adjust the terms if we have to, but if we can't find a home, we tried our best. Fully underwritten is if we're taking a $500 million deal to market, and we don't find anybody, we're going to hold the whole $500 million ourselves. And the competition is increasing in that market. There are banks that a year ago wouldn't fully underwrite $50 million. They're fully underwriting $200 million today. And that's a place that CIBC is also selectively getting more aggressive in.
Now, would you say that has more to do with the competition for the HUD business as it relates to the skilled? I'm sure you're seeing that a lot. Definitely, banks taking on larger opportunities and even more distressed opportunities in some cases for the eventual HUD exit economics.
Yeah, I mean, that's when I started. it was more, there was the HUD lenders and there's the banks, right? CIBC, when I was at Lancaster Power, we would do a bunch of deals with you guys, and it was like, here's, we do A, you do B. And then I think you've seen a morphing where either some banks, they try to have their own HUD departments, which, some large banks like KeyBank is pretty successful at that, and some will either invest in a HUD lender or partner, and it's, people are viewing this as one trade, right? So, a bridge loan might be a turnaround, it might be a little hairier, but if they're gonna get the HUD and those economics, there's more competition. So, it's just something we have to deal with, right? And that's where you'll see a lot of alliances between banks and HUD lenders and trying to figure out a way to do this all together, because there's things that the banks want. If I do a deal with one of the banks, we don't care about deposits or any of that relationship, which is a big deal to them. So we'll say, hey, you do the bridge loan, you get all the deposits, we get the HUD, we'll kind of be friends and figure out deals, and there's a lot of that going on in the market. So it's just rarely, I mean, you guys can comment on this, is there a deal that's done where it's like, this is just the bridge and there's no connection to a HUD lender, or something down the road where it's tying the client? And I'm just seeing a lot more of that, because deals are more competitive, right? So everyone's trying to get an angle to work together to build their business.
And for the non-banks in the space, I would say to Matt's point earlier about the larger portfolios that are trading, those are very sophisticated borrowers, and they don't necessarily want to assume the syndication risk. We did a couple of those portfolios last year. We're slated to do a couple this year. We've partnered with everyone here on the stage. When you're choosing a lender to do a portfolio that size, you really have to be comfortable that they're going to execute.
So I know it's not quite this narrow, but what you're all doing somewhat different things. What is somewhat of the sweet spot for each of you? What should people be bringing to you if they have a deal or know somebody that has a deal they're considering financing for, either an acquisition or refi? And maybe explain to us, where are the guardrails where it just definitely won't fit, either because of underwriting or geography or whatever? There may be a multiplicity of factors for you. Are there some sweet spots for each of you, and are there some that are just like, yeah, we're probably not the best for that kind of transaction?
My bank's been really good. I will not lose transactions on pricing, which is great, right? Not that I'm going to give it away, but as long as that has, and that's been consistent, talking about some of the previous iterations of what the hot button is, but it has been always a cash flow bank. So as long as I have something to hang my hat on, that we're pretty good knowing that this is not a big deep turn, that there's a diversification of assets, so that's covering for there. I mean, the best thing I've had with a lot of my borrowers is an existing portfolio. They may add a couple that are turnaround in there, but the power of the entire value, the portfolio helps it, as they make that turn, and they've proven it out. So my hit rate has been more on, I can be competitive on spread just so long as there is some level of cash flow. That's what we do well. What we could probably do better is when there's a good story and a good sponsor, is taking that into consideration and working with that, knowing that it's going to get to where it needs to be. But again, in fairness to my friends in credit and whatnot, they also have people over looking at them about those deals that aren't right there. Because I think if you look historically for all of us, right, the portfolio's in just a killer. It's in a great space right now, I think, with all of us, right? The whole space the nursing home space is doing well. But historically, where did we get ourselves in trouble? Probably the ones that we assumed were going to turn that just couldn't get to that point, right? So why go down that road if it's
So you're saying maybe bet on the jockey a little more, not always looking at just the horse. Okay, anyone else?
From a check size perspective, we can go as low as $10 million. On the high side, there's really no limit for us. Typically, our transactions somewhere are between the 30 to 150 million. I know that's a wide range, but just depends on the size of the portfolio. Our capital is as competitive it's ever been from both pricing and structure perspective. I mean, we're non-bank lenders, so obviously our cost of capital is a little bit different than Brian and Matt, but we're always willing to have a conversation. Every deal is reviewed on a deal-by-deal basis. Something that doesn't make sense with an operator in the market may make sense with a different operator in the market. Out of our $7.5 billion book, 84% is repeat borrowers. So we're very sponsor focused, very relationship focused, people that are going to do the right things, not only when things are going well, but when things are not going well also. And of course, you know, facility level fundamentals are very important. Is the sponsor willing to invest dollars in their facility? Do they have the regional team they need to scale? What are the reimbursement dynamics in the market? You know, I think those are all things that we all take into consideration.
Mark, you know, it's funny. I just reflecting on the last week, and I've issued a $6 million term sheet on an acquisition turnaround, and we issued close to $300 million on a full underwrite. So we are really running the gamut right now. You know, if it's a turnaround, hopefully it's well supported. You know, you've demonstrated an ability to operate in the state or in the area. Things that we're looking at, you know, clinical is becoming more important. We're not ordering clinical reviews all the time, but I've definitely ordered more in the last 5 years than I did in the decade before that. You know, other things that we focus on are capitalization of the balance sheet and cash flow.
I think you guys hit on great points. I would say one thing we always look at is, you know, that gives me pause is, you know, an operator going into a new state that doesn't have, either they're just like helicoptering in, right, or they don't have infrastructure. And that's where during COVID, we had some situations where luckily things didn't default, but we had to, you know, take, you know, a larger portfolio in one state. That one operator kind of came into a new state and find like 4 or 5 operators to help stabilize that, right? That was a lot of work. And then the other thing I would add, something we like to see, and I think the better operators are doing this now, is when they get a part of the real estate, right? Because the operators generate a lot of the value, right? So if there's an acquisition, our operators that are, you know, that have great reputations, they're just asking their sponsor landlord, we want 20-30% of PropCo, which or a purchase option that's in the money. So we know they're driven to buy it or create the value, and it's not just a situation where that sometimes you see in the private pay market where I buy an asset, I hire a manager for a 5% management fee, they're top line driven, and I really have no control to push, right? And there's really not like a, you know, they're not really not partners. So we like to see that. That's the only couple things I would add.
Yeah, it's a very localized business. So someone who is phenomenally successful in Chicago, you know, may or may not be as successful in Wisconsin or other, you know, Iowa or Kansas, another state nearby. Certainly, the further out they go, if they're very prolific in the Midwest and they go to the Southeast or the West Coast, that can be problematic for an operator. Unless they have those local experts. Again, going back to the typically young, energetic, you know, operators from that region. It could be, they don't have to be young, but, you know, someone that definitely knows their stuff in that local market. So, and a lot of some of the bigger companies, I know Enson's famous for, you know, putting a, you know, administrator and ED on site that's a mini CEO. You know, you want these operators to be, you know, have full authority, full responsibility for their facility or facilities, and reward them, you know, well for doing a good job. But really, that local person is so important. So, any final comments from the panel or questions and so forth, and then we can open it up for questions for the floor. Okay. Any questions from the audience for anybody up here? Yeah, go ahead. Question is, what's the average length of a bridge loan into HUD?
So we just looked at this for one of our investors. Our average for deals we've ever done or placed with banks has been like 30 months. So with HUD, there's certain rules. So if you buy a building and bring in a new operator, that operator has to be in place for a year before it can go to HUD. So, and usually an operator is going to have some value add plan. So maybe it takes them 18 months to get where they wanted, and then HUD's not, even though I talked about the express lane, let's still budget 6-7 months. So that's, you know, 2.5 years. If you do a dividend, which Karina's done, we had a couple deals she looked at where I bought the building pre-COVID for $10 and it's worth $20, and Karina gives you $16, right? Then you got to wait 2 years to go to HUD, right? That's just a rule. So then that loan's probably a 36-month loan. The quickest ones are the lease to purchase option we've discussed before, where I'm a tenant and I have purchase option. You know, you can go right away. So that deal might be in 1 year. So if we put those together, we've been right about 30 months.
And I would say the more sophisticated operators are either looking at that before they take on a leasehold to decide, you know, how long do I want that lease to be? Do I want to acquire the buildings right off the bat? You know, what are the economics for debt service versus lease payment? And they're mapping that out for themselves. So as a lender, when I see a package come across my desk and the operator's already done that work, that gives me a level of comfort knowing they're keeping an eye on that eventual exit, as am I. You know, we're a bridge lender. We're typically 2 years. We always say, as a joke, that we're in the moving business, not the storage business. So we want them to go to HUD. They want to go to HUD. You know, that's the ultimate goal.
And if I'm not mistaken, the bridge lenders typically maybe always underwrite the loan for HUD, right? And also look at the property, hallway widths, doorway widths, any kind of physical plan issues, star ratings, PCNA. There's a property condition report that HUD does. I mean, you probably have to look at some of that stuff, right? And to make sure you don't want to get stuck with a loan that's in bridge and can't go to HUD. Yeah,
We try to get the PCNA in phase 1 to be HUD compliant because, for example, like in California, you know, if it's in an earthquake zone and they require all this ridiculous work that, frankly, most clients won't do. Like we had one where they had to HUD wanted to drill into the ground with these struts. It cost like $2 million. So that's not going to HUD. So we tell the bridge lender, Brian, this one's not going. It'll be left behind so we all know. And there's requirements for the bathrooms, ADA. So usually bridge lenders that aren't in our space might make that mistake. You know, everyone up here is gonna underwrite it correctly, but I've seen some horror stories where a local or regional bank brings us a deal and they think it's going to HUD and there's no way, and then they're kind of stuck. So, but that's something we'll all work with the bridge lenders on.
And sometimes it's a care issue. Like there are certain types of maybe psych or like you said, some of the independent living. If it's a CCRC that has there's a certain percentage of a CCRC, a continuing care campus that can have there's a certain percentage of independent living, right, that it can have.
Yeah, right now it's probably like 25%. We're trying to get that increased to 50%. But I think, as you can tell from these questions, the length and volume of the HUD rules is what keeps me working. So it's just difficult. But we're hoping they're changing for the better to make life easier on the bridge lenders.
Go ahead, Joel.
Yeah, so just from the HUD perspective, because I think the bridge lenders, they can have a little more flexibility. But from the HUD perspective, if you're SFF or special focus, you can't go. But if you're 1-star, we'll evaluate kind of how you got there, right? And if there's a lot of G tags or above, HUD will kind of latch onto that. If it's staffing or some other metric that's associated with a certain state or even county, how they look at the stars, we can get through that. So we can get 1-stars through. Usually HUD will require a clinical reserve, like a 3-month debt service reserve for clinical. And they'll look at your whole portfolio. So even if we're doing 2 assets and you operate 20, they're gonna ask for your star rating on all of them, so we can try to tell that story. But it's not black and white, but it will come with some financial ramifications with that reserve. But if there's actual harm and a lot of high tags, that's where it's tough to get through.
Jason, is that financial reserve just a penalty, or is it to be used for mock surveys from third parties?
Yeah, I think honestly they don't really make you use it for anything. We'll get a clinical assessment as part of our application. I think it's almost like they think there's more risk, right? So that's another buffer for them if there's missed payments. Honestly, they don't say you got to hire someone to come give you an assessment. But most, again, to Brian's point you made earlier, the onesie-twosies have trouble getting with HUD too, because just to keep up with all the regulations and the rules and the value-based reimbursement, all the stuff they need to do, it's like if they're not actively monitoring their star ratings, it can be a problem. That needs to be a focus of theirs, because everyone, investors, CMS, like even though it's a tainted system, it's the first thing everyone looks at.
We've mentioned a few times special focus facility. What that is it's a group of facilities by each state that, hopefully not too many, but by each state that, you know, are less than a 1-star rating. They're a special focus of the state, and you have to go through, I believe it's 2 cycles of surveys at a certain level of what they call tags or findings, that proving that you are, you know, that you've improved the things that the state was concerned about before you come off the special focus list. And if you're on the SFF list, it can be problematic for your financing and all sorts of other things. So. Other questions? Those are good questions.
TPA timing depends on who your asset manager is, right? And I mean, with HUD, the production staff are like the most efficient workers. They're the ones putting stuff through the conveyor belt to get deals closed. Once you're closed, the asset management arm of HUD, it's almost like, you know, the major leagues and the minor leagues, kind of like the staff that isn't as, you know, friendly gets put into asset management. So your lender, you know, has to process that. And sometimes there's also not a huge motivation for a lender that's just being told to do a TPA for it being sold. So I would say the fastest we've gotten one done this year has been like 4 months. But I would say, you know, 6 to be safe. I mean, if it's a problem facility, HUD will move quickly, because if there's an operator that's doing something wrong or had a do not admit, they're going to do that. And a TPA means transfer of physical assets. It means you're changing the operator, or HUD loans are assumable. So I'm selling my building to Brian. He's going to assume my HUD loan. It goes through a transfer. But if it's like a deal that's doing well and there's no fire, HUD's kind of like, oh, we'll get to it, right? And that's where your lender or your servicer has to really push. But I would say 4 to 6 months.
And are the A7s still a thing? Is that a popular thing to do?
I mean, they're...
Explain how that works, too, to the audience.
Yeah, so once you're in HUD, you know, if you lock a rate today, let's say today the rate's 5.5, and the HUD rates are based on off the 10-year Treasury. If in 2 or 3 years the Treasury goes back down to 250 like it was, or 3, you can do... And you can do what's called an A7. It's a refi of existing HUD loan, where you can modify the rate, you know, and it's a new loan, but HUD doesn't have to underwrite your value anymore or anything like that. So when rates were very low, basically HUD's whole portfolio got recycled. But now most of the clients have rates that are like 2.5%, 3% if it's not a new deal. So what's most impressive is if HUD's volume last year, which set records, there was probably only like 10 total A7s. So it's an all-new volume, which speaks to the M&A and Mark being busy and everyone up here being busy. Now, we're closing all these deals now. If in 2 or 3, 4 years the 10-year Treasury drops 200 basis points, there'll be tons of those done again, which is just it's not new credit to HUD. It's just if they're an insurer and they can reduce the rate to their nursing home owner, they're going to do it because it improves the viability of the insurance fund.
Yeah, and just in case someone's never looked at a HUD loan, you know, one of the great things about them is they have a 35-year, you know, fully amortizing schedule. So you never have to have another loan if you don't want. They're fully non-recourse except for what's known as bad boy carve-outs, and they are assumable. The challenge can be, you know, so if you're looking at when do I do a HUD loan, when do I not, you do have to be ready to, you know, have that loan in place for a while, because there's a, is it 9.8765% penalty? So there's a penalty that starts at 9% of the loan balance. It goes down to 0, I believe, over time. So, you know, you don't want to do a HUD loan for a building that, you know, you plan to double the NOI and sell it for double what you paid for it a year later. Just that's probably not going to work, because the loan to value is going to be too low for the buyer coming into the deal. We've had situations where there's a HUD loan on a property, you know, $5 million on a $20 million building is just not going to work, because, you know, no one wants to put $15 million on a $20 million purchase. So, but, you know, those are the advantages of HUD, and, you know, that would be the one challenge is the LTV. The A7 allows you to go back up to the original loan value, but if it was start at $5 million, you're not going to go up to the 20, you're going to go up to the 5. So.
Get rid of it? No, so it's right. It's paid on the principal, so every year, you know, it's going down. But as I kind of stated before, we're, as an industry, we're trying to push to try to get a reduction in MIP for senior living like multifamily got, and maybe make it risk-based, because, you know, multi got reduced to 25 basis points, right? And we're still 65. So we're trying to get that down.
And I think, am I right, in residential, I think if you have FHA financing, which is the same division as HUD, I think that goes away too in resident, like a house. Like if you buy a house and you have FHA insurance. Is that what it is? Yeah.
Yeah,
So
I
maybe
know.
they can do something
We're
like
trying. I mean, that's here's the risk, right? Like, if we can mirror multifamily as an industry, I think that's smart. If you try to go further and there's a big blow up of a nursing home chain in the New York Times, and then someone gets dragged in front of Congress and they say, "Why are you insuring nursing homes?" Could be bad for all of us. So it's like, if we can get close to multi and just be in that range, I think that would be fair for the industry, because we're way higher right now, right? And the default numbers aren't that much higher than multi. So mathematically, if you're an insurance fund, you should. But the thing is, there's no other competition for permanent loans for nursing homes. So if I'm HUD, it's like, well, where are you going to go, right? There's nowhere else to go. So if they were a private company, they'd probably be raising that, but we're trying to get it reduced.
I think the the factors that caused some of the troubles with borrowers in the period of time when rates ran up on folks was just that. I think where people got in trouble was they borrowed money at a rate of, like Jason was saying, rates were maybe 3.5%, which is fine. You're deal underwrites at that level. But if you had an adjustable rate loan that went to 6.5%, it could squeeze all your cash flow. So as long as folks are underwriting, to the ultimate rate that it could be, if it's a floating rate loan, or they're doing a fixed rate loan like a HUD loan, and I'm assuming most of the people on the stage do fixed rate lending, you're not going to run into some of those default problems. So what I'm saying is the default rate is really low for fixed rate loans. Are we out of time here? I see people running around. I didn't see what he said.
Yeah.
Okay. All right. Well, thank you for attending this morning. Appreciate it. If you have any other questions, feel free to grab us.